U.S. mortgage market statistics for 2018. This is exciting stuff, my friends. Housing dominates all else when it comes to your own financial planning. And unfortunately, that becomes a lot of people have mortgages too. And so we need to take this into consideration when we're looking at financial planning as a whole for sure. So let's dive right into this. Don't forget to subscribe, of course, thumbs up, comment, and of course, share this video with others. And again, I apologize for my raspy voice. It's not like I picked up smoking again. I just fighting off a cold here. So let me make this a little bit bigger. All right, so this is from Magnify Money via Lending Tree. So they have good stats on this stuff. And I got a lot of good information out of this article, actually, which I think you will too. Let's see, the editor. Okay, content on this page is not provided or commissioned by any financial institute. Okay, whatever. All right, so here's, I don't know who this guy is, Tendai Capfidzi. Homeownership rates in the U.S. have increased steadily since the height of 2007 and 10 housing crisis. Despite this, increasing interest rates and high home prices have kept the homeownership rate much lower throughout 2018 than it was during the era before the crisis. Well, also because they're not doing ninja loans anymore, or at least I hope they're not, which is no income, no asset, no job or asset. Ninja, no income, no jobs or asset. That's what they call it for loans. As long as you can fog a mirror, they give you money. Housing prices have recently begun to cool, which may create opportunities for some would-be buyers to afford a home. But this does not mean the home ownership rate will approach its previous peak level anytime soon. Nonetheless, the overall housing market is in a healthy state with very low levels of distressed loans. Throughout this piece, we dig into a broad range of housing metrics to help paint a picture of the current state of the market, explain who gets home financing and how mortgages are structured and how Americans are managing their debt. So total mortgage debt is $10.3 trillion. Average mortgage balance is $148,000. See, let's go down to number two. See where this tells us who's number two. That's from the Survey of Consumer Expectations Housing Survey from the Federal Reserve of New York. So that's pretty interesting. I'll have to do to look at that. A lot of times I'm looking at this stuff. I like looking at the notes, actually. That gives me other stuff to read, which I can share with you. So I have to look at that, actually, because the average mortgage balance, I don't want averages. I want medians. Medians, what we're looking for. Average new mortgage balance, again, is $260. Homeownership rate, share of owning about 65%. So basically 2/3 of all people who live in a home own it, that's pretty cool. Homeowners with a mortgage, about 2/3 of them have a mortgage too. Credit score, average down payment, don't care about that. Mortgages originated in 2017, $1.75 trillion. Share of mortgage. This is what I thought was interesting. Share of mortgages originated by non-bank lenders was 51%. That's crazy. So banks originated 40% of the mortgages, credit unions 9%, and non-bank lenders issued 41%. And 51%. That's just odd to me. What is a non-bank lender? It doesn't say there, so we'll have to look at that a little bit. I thought that's one thing I saw was interesting, but I don't even know what a non-bank lender is. All right, so let's keep going down. Share of mortgages with a delinquency rate of 30 days or more is 3%. And that's pretty low, so that's good. They talk about credit scores here. 3% of mortgages on single-family homes are in delinquency with at least 30 days past due. In 2010, mortgage delinquency rates reached 11.54. Wow. In the second quarter of 2017, real estate values in the United States surpassed a pre-housing crisis. As of the third quarter of 2018, the total value of real estate owned by individuals in the U.S. is nearly $25.6 trillion. So in that case, we just say $25.6 trillion is total value. We come up here to how much we have in debt, which is $10.3 trillion. And we know we have total equity. It's going to be right there. Yep, about $15.19 trillion because $25 trillion is the total outstanding value. 10 of that is debt. The rest is home value, $15 trillion. And this gives me hope, actually, for retirement because, again, going back to reverse mortgages and downsizing stuff, that's $15 trillion. You're not going to be able to access the whole tire on a reverse mortgage. You don't get the whole $15 trillion. But that does give you hope to say you can have access to some of that cash for your own retirement planning, either through downsizing or reverse mortgages. And I just, the idea of not using that into any kind of financial planning consideration, it boggles the mind. $15 trillion of assets. is owned outright by homeowners, where only $10 trillion of asset is owned by the bank. That's real value there. However, real estate wealth is becoming increasingly concentrated as overall home ownership rates fall. Here's a very misleading graph. And I just see, we can have fun with numbers and graphs all the time. But look, so we got 64%, 63, 64, historically 85, 87, 93, and then it went up from 95. And that's, Clinton signed the CRA and a lot of Community Reinvestment Act. Did Clinton sign that? I think it was CRA. I think it was Clinton. Maybe it's Bush, the first Bush. I can't remember. It was a horrible act. But anyway, but Fannie Mae really got rolling badly, in my opinion, most people's opinion, in the Clinton era. And I'll never forget Barney Frank, who actually I have some appreciation for, believe it or not. But was it Frank? Some pretty high-ranking liberal Democrats basically saying Fannie Mae has got no issues whatsoever. Fannie Mae's imperfect, is strong, and it was just wrong. The guys were it was all wrong. All lobbyists from Fannie Mae bought these guys. They bought Republicans too. But anyway, homeownership rates in 2005 hit 69%, and then we're right back to where we've been historically, which is about 64%. So that's not, that doesn't bother me in the least. I mean, that just shows you 2/3 of people should have homes and 1/3 of people should not. I got no problem with that. New mortgage originations. Mortgage origination levels have recovered from the housing crisis in 2008. In 2008, financial institutions issued just 1.4 trillion of new mortgages. In 2016, that topped 2 trillion for the first time since the end of the housing crisis, but still we're 25% lower than pre-recession average, which in my opinion is pretty good. New first lien mortgages fell to 1.8 trillion in 2017. Well, that's still pretty good. That's better than it was. That's still a lot of mortgages being originated for sure. Let's see. Through the second quarter of 2018, banks originated just 820 billion in new mortgages, which is 20 billion lower than it was at the same point in 2017. And just higher interest rates, I imagine. I don't know, but maybe people are saying, I don't know if I want to buy a home. I don't know. As recently as 2010, 3 banks originated 56% of all mortgages: Wells, Bank America, and Chase. But in 2017, Wells, Bank America, and Chase, and all banks put together originated just 40%, that's crazy. Non-bank lending, both credit unions and non-depository lenders have continued to cut into bank share mortgage market. In 2017, credit unions issued 9% of all mortgages. Additionally, 51% of all mortgages in 2017 come from non-depository lending institutions like Quicken Loans and PennyMac. That's interesting. Quicken was a third largest mortgage issuer in 2017. PennyMac, I don't even know what that is, issued $17 billion and was the 5th largest overall lender in 2017. Where are they getting their money from to issue the loans? I don't know. I don't know how that works. That's interesting to me. Are they just going out and selling them? Like, where's Quicken? I don't know. I mean, you think about it from a bank or a credit union perspective, they're depository institutions, all right? So you deposit CD money, they take that CD money and bank money and checking and savings, they loan it out to mortgagees. But where's Quicken? I don't know how that works. That's interesting. I don't know what to make of that. Government versus private securitization. Banks tend to be more willing to issue mortgages new mortgages if a third party will buy the mortgage in a secondary market. This is a process called loan securitization. Consumers can't directly influence which entity buys their mortgage, but mortgage securitization influences who gets mortgages and their rates. Government-sponsored enterprises, GSEs, have traditionally played an important role in ensuring banks issue new mortgages. Through the second quarter of 2018, Fannie Mae and Freddie Mac purchased 44% of all new mortgages issued. I wonder if they buy them. Do they buy them through PennyMac and Quicken? I don't know. As private securitization firms exited the mortgage landscape, programs from the FHA, the VA have filled some of the gap. The FHA and VA are designed to help borrowers get loans despite having smaller down payments or lower income. That's going to be your Ginnie Maes right there. FHA and VA loans accounted for 23% of all loans issued in 2017 and 22% in the first half of 2018. In 2017, 24% of all first lien mortgages were financed through FHA or VA. Again, that's going to be Ginnie Mae. That's interesting. Mortgage, I don't want to go. Credit source at origination. Let's keep going down because there's a couple of things I want. Mortgage origination by FICO score. All right. And there's a lot of numbers there. All right, let's keep going down. Oh, right here. Debt to income ratio. This is what I like. All right, so all the banks have tightened lending standards relative to maximum debt to income ratios for the mortgages in response to the market crash of 2018 or 2008. They've recently begun to show signs of loosening these standards. For example, the average debt to income ratio is 35% in 2017, which is higher than 2016, which is 34%. And 2007 is 38.4. So here's 2007, 38.38. Here's 2012 with 31.2. I'm telling you, that's a big deal. If your average debt to income is 31.2, it's going to be tough to loan for a lot of people because they're so heavy in debt. And remember, that is based on your monthly credit that you have. I mean, that's your car loan, your student loan, the mortgage that you're looking at, relative to the income you got coming in. And so, I mean, that's tough. 2012, that is tough, my friends. It's nice to see it go back up. Long-term loan to value and delinquency trends. Banks continue to screen customers on basis of credit scores and income, but customers who take on mortgages are taking bigger loans than ever before. Today, a new mortgage has an average unpaid balance of approximately $260,000. Wow. So there's your average unpaid initial loan size, 205, and here's what's that, 260. That's interesting. So in 2007 and then in 2009, 205, then 2009, 196. But that's just the average loan size. That means the loan had to be approved. And it's, either way, that's a pretty significant. Look at that. Going up, up, up. The primary drivers behind larger loans are higher home prices, but lower down payments also play a role. Prior to the housing crisis, more than half all borrowers put at least 20% down, and the average loan to value at loan origination was 82%. And this is a scary thing now. In 2018, the average loan to value has about 87%. That's not good. So that means there's too much loan relative to the equity. That's kind of scary. We like to see a lot more equity for sure. And here we go. Median. Oh, here's a median right there. So the median loan to value is 90%. Look at that. That's the difference between average and median, by the way. Here's the average, 86. Here's a median, 90. Here's a median in January 2018, 96.5. I mean, that's hardly any equity at all. Look at that. The median and the average, significantly different. 2000, look at this right here. 2000 and what's that? 2007, the median was 80% and the average was 84. That is weird. Look at that though. But generally speaking, at least since the crisis, the median loan to value is much, much higher than the average. But that wasn't always the case. So here's a median, 80%. That just means 50% of the people are putting 20% down and 50% of the people were not. Yeah, that's good. Loan to value ratio American homes. So let's take a look. All homes loan to value mortgage. Okay. I don't get that. Okay. So here, all right, this is interesting. So when you factor in, all right, so let's look at this. As of 2018, November, the average loan to value across all homes in the United States is estimated 40%, but the average loan to value on mortgage homes is 63%. This is substantially higher than the pre-recession loan to value of approximately 60%. Between 2009 and 2011, more than a quarter of all mortgaged homes had negative equity. That's crazy. But today, just 4.2% too. So here, if you look at all homes out there, mortgaged and not, the average loan to value right now is 40%. That means people have 60% equity, 40% in debt on the average for everybody, mortgages and not mortgages. Obviously, there is no loan to value if you don't have a mortgage. So if you take in just mortgage homes, you'll see right here, the average loan to value is 63%. But didn't we go up here? Just the average loan to value, average debt to income. I thought we had average loan to value up here. I can't remember. Yeah, I forgot. But anyway, if you have no debt, then you don't have a loan to value. Your loan to value is nothing. I mean, you got no loan. Loan to value, that's that mortgage origination. But if you don't have, I just wonder what the average loan to value is if you don't have, if you take out the people who've had their house paid off. I bet it's 80%. It says average loan to value at mortgage origination, not currently. I don't know. Anyway, that's interesting. Delinquency rates have fallen off a cliff. That's good. I mean, look at that. We're down to 3.01%, which is down to, I mean, we're talking, I mean, pretty the lowest we've seen since 2007. That's good. Mortgage debt, I mean, this one's huge right here. I mean, the debt service payments as a percentage of disposable income. I mean, look at that. The lowest has been for 20 years, 4.2%. Even in April 2000, it's 5.57. Americans continue to manage mortgage debt well. Current homeowners have mortgage payments that make up an average of just 15% of their average household income. In quarter three of 2018, mortgage delinquency rates were 3%. This low delinquency rate is, well, we already talked about that. All right. Mortgage debt service payments as a percentage of disposable income have fallen to the lowest since 1980. So there's some good stuff in there, man. There's some good stuff. I like seeing this. Debt service payment as a percentage of disposable income. But I don't know what to make of that. I like it. But does that mean everyone's doing 30-year loans? I even heard there's 40-year loans out there, and I don't like that. I mean, you can make your average debt service to your income if you just stretch out the loan long enough to make the monthly payment seem minimal, but you're not paying any of the principal down. But anyway, that's interesting. So that's some good stuff there. A lot of good stuff in here in terms of the footnotes that we'll talk about. But a lot of good stuff to be fond of the current housing situation that we see here today. So anyway, as always, hope you find this helpful. Board of Governors, Federal Reserve, calculated metric value of U.S. real estate mortgage debt held by individuals. I'll look at them. Let's just take a look here. Well, I'm looking at that. Owner occupied. Oh man, I shouldn't have opened this because now I'll never be able to get this video done because I love this stuff. Owner occupied real estate, including vacant land and homes at market value. All right, I probably won't dive into this right now just because lots of economic research from the feds of St. Louis. Anyway, all right, we'll stop that. We'll look at this at a different time, but it'll be interesting. So stay tuned. Don't forget to subscribe, thumbs up, comments always. We'll see you guys next time. Thanks now.